Hello learner, welcome to Manifested e-learning platform. My name is F.A.M. Lingwiri, and today, ladies and gentlemen, we are discussing about the financial modeling and data analytics paper, which came in April 2023. The question in focus is question 22. It reads as follows. Let's read together. As a senior financial analyst at Wema Capital, you have been tasked by the chief investment manager to develop a financial model for a new startup company that plans to manufacture and sell electric bikes components in the country. The following information is provided. Number one, the company is expected to produce 1,000 units annually, 1 million units annually, pardon me. Number two, the unit selling price is expected to be 18.5 in 2024. The unit selling price is expected to increase by 5% annually. Number four, the cost of goods sold percentage of revenue is 42%. The salaries and benefits expense as a percentage of revenue is 17%. The annual rent and overhead expenses are 500,000. Number seven, depreciation and amortization percentage of property, plant and equipment or PPE is 25%. The interest rate percentage of debt is 10%. The applicable tax rate is 30%. Number 10, the accounts receivable days is 30. The inventory, number 11, days is 14. Number 12, the accounts payable in days is 30. Number 13, capital expenditures in year 0 is percentage of 15 million. It will be funded by debt issuance of 5 million and equity of 10 million. Required. Using Excel, A, prepare the following financial statements. Number one, the statement of profit and loss for the 5-year period. Number two, the statement of financial position for the 5-year period. Number three, the cash flow statement for the company for the 5-year period. B, we are told, undertake an analysis and compute the following financial ratios for the 5 years. Number one, profitability, that is the return on assets, return on equity, and net profit margin ratio. Number two, liquidity, current ratio, and quick ratio. So ladies and gentlemen, we can start solving this question. On the on your right hand side over here of the screen, you can see the solution. So we move to the right over here, and we start by creating the income statement or developing the income statement. So before we develop the income statement, the assumptions need to be created. So we write over here, assumptions. What are these assumptions? The assumptions are provided to you right over here. And these assumptions will guide the 3 statements which you've been told to answer right down over here in part A. Statement of profit and loss, statement of financial position for the 5-year period, cash flow statement for the 5-year period. So we need the assumptions tab. And under the assumptions, we start now identifying the revenue growth rate over here. So we start by identifying, so you can bold this, Control B, there, that. And then here, we can start with revenue growth. That. The revenue growth will be moving for how many years? We're starting from year 2023 because we're assuming that that's the current year over here. So then we'll go now 2024 and moving ahead like that. So we put in the years right here. So 2023, like that. Then we move on over here plus that one plus 1, 2024. And then we can go up to plus 5 years up to 2028. Just drag it like that. There. This, we can put it in bold, Control B, straight out like that, so it can be able to indicate the years there. So what have we been told for the revenue growth? We're saying the unit selling price is expected, or the sales or the revenue is expected to increase by 5% annually. So we just put in terms of revenue growth in terms of right over here, screen, we just put 5%. So first of all, like this, we highlight this section here, put percent. You can see percent is here, and you just put 5 like that. So the ones we've modeled the growth rate, come up with assumptions for the growth rate over here, then we identify, of course, we can be able to now just say that one is already done. Here we can perhaps maybe put it in red, but we'll put it in red when we develop now the income statement. And we've actually actualized the 5% annual growth. The next item is the units produced. The units produced, you can see, is right over here, note number 1 here. So you can write towards the right over here, units produced. Units produced. And with the units produced over there, we are saying that it's going to be 1 million. It's going to remain constant as at 1 million over here. So that. And of course, because we're going to put the comma format, come right over there, put the comma format. The accounting way of doing it, the financial analyst way of doing it is for it to have visuals like that. So just press Shift, Control R. It actually represents over here. And we're saying that this needs to be spread out very well. So you highlight and then you double click. That comes out like that. That is units produced. Then we can proceed on to compute the cost of goods sold, or the unit selling price is 18.5. You can put selling price, unit selling price, and it's 18.5. Remember, it is for the year. Remember, for year 2023, we may not have been given over here, but you're seeing from year 2024, the revenue growth should actually be from 2024 should be 5% and 1 million. So these ones should not be able to exceed. But in terms of the number of units not produced, but you're saying that the unit selling price in year 2024 is 18.5. So that one we should be able to include it right over here, 18.5 unit selling price. Selling price. Unit selling price. But here is 18.5. That. So we move ahead, and we've already modeled these three right over here. The cost of goods sold, we need to model that. So we'll come up with assumptions. The cost of goods sold as a percentage of revenue is 42%. So we are saying it's going to be 42% moving ahead. So the cost of goods sold percentage of revenue, 42% there. So say COGS goods sold like that. So saying here it is G, the G should be small letters. Why? Consistency. That. So cost of goods sold, here we've been told that it, for 2024 is 42%. It should be 42%. So we put percent here, 42%. But we haven't been told whether it's going to remain constant right over there. That's now what we need to try and be able to identify there. So after that, the salaries and benefits expense as a percentage of revenue is 17%. So 17% remains constant, salaries and benefits. Fees and benefits. That, just double click here, sort of like that. And we see it's 17%. Like that. But my assumption is the cost of goods sold, should remain constant like that. It only makes sense like that, so I'll just model it like that. The Salaries and benefits should also be 17% across. They would have told us if there was any change in the cost of goods sold as well as the salaries and benefits. So here we're told is 17%. 17, I'll first of all put the sign like that here, then we just put it sort of like that. Salaries and benefits. Let's move on to the next item under the assumptions tab. So we've done those ones there. So the annual rent and overheads is going to be 500,000. That's annual, 500,000. Rent and overheads. And overheads, that is 500,000. And here it's not percent, so we put the comma format like that, 500,000. That, and we don't want it like that. We just want it to be, flat figure, like that. And we just drag. So once we have the rent and overheads given to us there in the assumptions section, then we can move back to the question and identify the next item, which we're saying is depreciation and amortization. And this one is based on the percentage of PPE or percentage of pre-PE. So we come over here like this. And amortization. Like that, then put in brackets percentage of PPE that. You're saying it's going to be how much, so we double click it like this. Here is, we can go back, let me just find out, it's 25%. So if it's 25%, so here we're saying it's going to be 25. Here, remember, we need to sort of put it, so 25. And we shift, Control R, that's the assumption. We've not been told anything about the changing value of, depreciation and amortization in the terms of this rate. So next item, number 8 here, the interest rate as a percentage of debt is 10%. Interest. Sorry, pardon my spelling, interest. And you put in brackets over here, percentage of debt. Like so. Here we put it for consistency of PPE. Rent and overheads. So salaries, if I remember, let me just try and focus on it. Percentage of revenue. Yes, it should be percentage of revenue. And hotels, percentage of revenue. Let's see, cost of goods sold. Yeah, that's the cost of goods sold. Yeah, so it's percentage, both of these, the cost of goods sold and salaries is percentage of revenue. That. So here I can say salaries, percentage of revenue. Shift percentage of revenue. That. This D should be capital. And then this should also be the same. So this item should be copied. Percentage of revenue, like that. Oops. Percentage of revenue, copy. Percentage of revenue, close the brackets. Move on like that. Close the brackets. So once we have the interest on debt given to us there, we need to put in the values moving across over here. So the interest on debt, let me just try and recall right here. Note number 8, interest on debt, percentage of debt is 10%. So we put 10% moving across. percent, and then Control R, like so. The next item is the tax rate should be 30%, flat figure there, tax rate. Is of course going to be as a percentage of earnings, yeah. Percentage of earnings. That. So here, percentage of earnings should be 30%. We've been told 30%. 30, that. Then we sort of undo that. Control R. That's the tax rate. Then now we've been told something else about now the balance sheet items. I believe so. Yes, we'll be told the balance sheet items in terms of the accounts receivable right over here. So the accounts receivable. Accounts receivable. And this should be in days. What have we been told? Let's move to the assumptions. To the question itself. Accounts receivable note number 10 is 30. The days is 30. So it should remain constant like that. So 30 days. This is not percentage. So we need to put the comma format. That's we put 30 now. That. And of course, we do not want it in like that. So shift that. Next item is inventory. Days is 14. Inventory days. Brackets days. And as usual, percentage like that we do not want. So we want to copy the format. Come to Format Painter. Come right there. Put it like so. So we put 14. Then we fill it in. Control R. So we're moving along. Inventory is 14. The accounts payable and capex has also been given to us there. Accounts payable. This is of course in days. So we've been told the days, how much, just to confirm. Note number 12, the accounts payable days is 30. It's 30. 30. So the comma format. 30, like that. Once we have the 30 there, we can then develop our assumptions for capex. Year 0 is 15 million. So 15 million. Capex, capital expenditures. Capital expenditures. Here, what have we been told? In year 0, capital expenditure in year 0 is a percentage, and we're told it's 15 million. 15 million. It will be funded by debt issuance 5 million and equity 10 million. So total of these 5 and 10 should be 15 million. So we can now say that debt issuance it could be either issuance or repayment. When you repay debt, it becomes a negative value. When you are issuing, it becomes a positive value. So debt issuance should be positive, debt repayment should be negative over there. And then you've been told equity then we're saying equity is either issued or repaid. Repaid. So here capital expenditures, just to confirm, 15 million. So this is 15 million capex. So here should be 15 million because we've been told here 0. This is 2023 15. It's 15 million like that. So we just put the comma format, reduce the zeros. And then it will be financed by debt issuance 5 million and the equity 10 million. So debt issuance 5 million and then here 10 that. So we have that given to us there. And what we can do now, because we have strict financial experts, we need to put the inputs to be in blue over here. So all our assumptions here should be in blue. So what we do, we just come over here, drop down window here, not this blue over here, let's go to more colors. Come over there, and we can be able to select a color such as that one there. Then we say, okay. That shows that those do not have formulae. You can change these values because these values will be tied towards the income statement. Now we come and develop down over here with your permission. Once we have the assumptions here, we can maybe perhaps decide to put it up to there to show that that's the maximum point where we are reaching. So we can put it in a different color over here and put it maybe say in a color such as that color there, faint blue like that. Then we come down. After the assumptions, we can come down and answer the first part of the question. Prepare the following financial statements. Part A, the statement of profit and loss for the 5-year period, statement of financial position for the 5-year period, and statement of cash flow statement, and the cash flow statement for the company for the 5-year period. So we are going to do all the three. So statement of profit and loss is the first thing that we are going to do. And we start of profit and loss of profit and loss. Profit and loss, like that. So in a similar fashion, over here, we're going to just format painter because we want it to look the same up to there. Statement of profit and loss. How do we, what is the first element we start with? Revenues. So we start with revenue. That. We're not dealing with this current year revenue. This is just to give us a guide of the starting point we're supposed to start. But we are supposed to create a forecast based on the current values here. So what do? We just try to make sure that it's almost the same in terms of the format over here. Just try and maybe perhaps squeeze it a bit like that, if you don't mind. Double click like that. So from here, moving forward is what we're saying is going to be the forecast value. So what do? We put forecasts right over here. So even if we were to just drag it like that, 2023, and then we come over here and say field series, it's okay. But now we're talking about what? The forecast. F. Because these are not actual values. These are forecast values like that. That. That's more like it. This is the actual values over here, but we do not really have the values here. But we are trying to focus based on the information given to us. So we come to revenue, and we can see we've been given the revenue growth as 5%. So we've been given the units produced and the unit selling price. So the unit selling price times the units produced will give us the revenue itself. So we come over here, plus the units produced, because it's a formula, units produced, you multiply with the unit selling price, and you enter. So what I want us now over here is, because this section moving down over here will be the accounting format, so I put that, and then I put 2 zeros like that, so that now it cannot disturb us now. So that is it. So how do we model now the years 2025, 2026, and so on and so forth like that? So we are saying that the growth rate is 5% moving forward. So it's pretty simple. You pick the previous revenue and you add a factor increasing the previous revenue by 5%. How do we do that? We multiply by 1 plus the 5%, this growth rate over here for 2025. Then we close the bracket and we enter. That's what it gives us. And if now we are to drag it moving across, it will give us the corresponding values based on the increase. That. Moving on, we can model now the cost of goods sold. Just pick cost of goods sold there. So cost of goods sold as a percentage of revenue. What I've done is just I just put plus this item over here. That's what I've done. And that's why you can see it's written over here, plus C8. So it's just picking what C8 is. C8 over there, C8. So how do we model cost of goods sold? And over here we are told that the cost of goods sold as a percentage of revenue is 42%. So if you can put the formula over here, and margin center over here, if the formula for COGS percent is given as, and over here of course we're going to try and center it as much as possible, cost of goods is just given COGS over revenue. That. So this is the formula that you need to remember. Cost of goods sold over revenue. That. So if the cost of goods sold over revenue gives us 42%, so this is already the 42% which has been given to us here. We already have the revenue given to us. These are the revenues. Can we then get the cost of goods sold figure, which will be able to fit in right over here? Yes, we can. The COGS percent, the 42% moving across there, we multiply with the corresponding revenues, will give us the COGS. Hence, plus the revenue, which is this one over here when you cross multiply, then you multiply that with 42%, will give us the COGS of the cost of goods sold. And then you just drag it moving across. That. So we haven't been told anything that alters the cost of goods sold component. So we've just been told it is going to remain at 42%. So we can move on towards the right and continue by filling in what the gross profit is. There is no adjustment over here, so gross profit. And this, because it's a, it's a value over here. Remember, these ones have got formulas, that's why they are black in color. So we are saying we're just going to get, need to underline that here, and we say here we are getting them now as revenue. You subtract cost of goods sold, enter, get 10.7 million. Once you get that, you move sort of the formula towards the right so that you can be able to get the solution. So now we talk about now the expenses over here. That, and you can be able to put it bold. So we start the first expense over here moving down as what? I may not remember. The first expense should be salaries and benefits. You can see up over here, salaries and benefits. So we put plus, we just go up to salaries and benefits there. Say enter. And for salaries and benefits, we are seeing it is as a percentage of revenue, so 17%. So we can just change this formula. Percent. Salaries and benefits percent. Like that. Salaries and benefits percent is given as salary and benefits, salaries and benefits divided by revenue. So we have the revenue given to us there. It's this one which is moving across there. And we have the salaries and benefits percent. Can we get the salaries and benefits? Yes. In a similar fashion of the way we did the cost of goods sold is what we're going to apply right here. Hence, plus revenue multiplied by salaries and benefits percent. That. We move